This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap podcast. I'm your host, Robert Kraft. Thank you all so much for the continued support and for tuning in. If you like what you hear on the Planet MicroCap podcast, please take a moment to rate us 5 stars on Spotify or Apple Podcasts. It really helps more folks discover the show and join the microcap investing community. Registration is now open for the Planet MicroCap Showcase Toronto, happening October 21 through 23, 2025 at the Arcadian Loft in downtown Toronto. Whether you're a seasoned investor or just getting started, you'll definitely want to be there. Visit planetmicrocapshowcase.com to register, and I'll see you in Toronto. Now, my guest on the show today is Ben Brostoff, software engineer at Klaviyo and the writer behind the Stock Talk newsletter on Substack. Ben has a fascinating perspective on investing. He started out in investment banking, taught himself to code, and now spends his free time researching microcap companies, especially in the software and tech space. In this episode, we dive into Ben's investing philosophy, why he targets 8 to 10% returns with the least amount of risk, how AI is changing the way he evaluates software moats, and why he won't own a company unless he's written a blog post about it. We also dig into some of the key lessons he's learned, from the dangers of leverage to the power of doing more than just reading a 10K. Ben shares actionable frameworks for evaluating microcap software companies, offers a nuanced view on AI's impact on infrastructure and margins, and explains why, for him, true due diligence means turning over every rock. And for full disclosure, Ben mentions a number of ideas on today's show. I am not a shareholder in any of them. Thank you again for tuning into the Planet MicroCap podcast, and please enjoy my conversation with Ben Brostoff. Ben, thank you for joining me today. How you doing, man?
Robert, good to be on. Long-time listener, first-time caller, so very excited.
There you go, first time. Oh, I love that. We should do it live, man. Then we can have it actually be like, oh, first-time caller, let's go. And then it ends up being an hour. It's like, wow, you didn't have time for any other questions because you just took my call. But yeah, man, look, I'm really stoked that you decided to, that you accepted my invitation to come on the pod today. We met in Vegas. That was first time, I think. Was that your first investor conference or first microcap conference you've been to?
First microcap conference. I started off in investment banking, so I had done like a few trade shows and things like that way back in the day. And then, I'm a software engineer now, so have been on and off to kind of more DevOps, software-oriented conferences, but first investing conference in quite a while.
Very cool. All right. Well, that's quite a jump from investment banking to then software engineer. So love to get your background, how you get caught up in the world of microcaps.
Yes, it's a long story, so feel free to jump in at any time. I went undergrad for economics, and I was pretty dead set on doing sell side and then trying to roll into buy side after 2 or 3 years. I feel like that's what everybody who graduated probably shortly after the financial crisis and went to kind of a big school had in mind. But I feel like actually doing the job of iBanking versus seeing and hearing and reading about it is quite different. Still an amazing experience, and I'm still super thankful for the 2 years I was at Wells Fargo. I was on their commercial operating asset finance team, which at the time was doing commercial aircraft and container lease securitization. So skimming ahead in this story, for my blog, 2 stocks I covered a lot were Trident and Textainer, who are now private companies. They both were bought by private equity. But on the container side, I was working with those 2 companies a lot. Basically, like similar to Consumer Portfolio Services, who's at the conference we were at. The container lessors will basically originate a bunch of container leases and then securitize them and then keep the equity slice. And that business model works really well. They can go about 4 times levered, and the stocks did quite well. It's not like they generate crazy returns on equity or anything, but it's a very stable business. You've probably been at like subway stations or been driving around and seen Trident or Textainer containers on the big trucks. I mean, it's a very steady business. But that's what I was doing at Wells a lot, and it gave me kind of a very good idea of how leasing and securitization work. We actually did lend on balance sheet a little bit, so there was also a credit risk component. So I had to analyze those leasing businesses, and then also the lessees too, which are shipping lines, which are not as good businesses, but I mean they are relevant for thinking about how's the lessor going to do. So did that for 2 years. Really liked it, but I think there was a part of it where I'm from Boston originally. Love Boston sports. My first time caller thing at the beginning. It's still a shameless listener of 850 and all the talk radio stations. But wanted to go home, and also had thought more about, do I want to work for a big company? Wanted to do something smaller. I think I had just read Mark Andreessen's "Software is Eating the World" thing in the journal. So basically, it was like, how can I do this? Get to a smaller company, get back to Boston, and then maybe do something in software. Really, ended up teaching myself how to code. We did at Wells like quite a few Excel models that were very VBA driven, and kind of they were kind of mini scripts and things I would do through that. That was a part of the job I ended up liking a lot. So I was like, why don't we just see if we can do this full time? We got a very small startup to take a chance on me. Several startups later, landed at Klaviyo, where I've been for about 5 years. It's funny, when I joined, probably was kind of in that MicroCap territory. I think it was like a $750 million valuation. And I was very hesitant about accepting the offer, because it was like, isn't this really MailChimp? This is an email marketing company. There's tons of them of them out there. And this is something I'm sure we can talk about with investing. As I spoke to more people who worked there, and even talked to folks who worked at HubSpot and some companies that competed in deals with Klaviyo, it became more obvious to me what the product was. And I really fundamentally was like, this actually isn't email marketing. This is personalization. This is kind of the brains behind your marketing engine. So that was definitely a pivotal experience with a lot of how I think about tech and investing in different companies, and trying to think about what's the product really do. So I think right around COVID, I started my blog. Like many people, I was like, I want to actually start really diving into why I do the things I do with investing. Because I think with your personal account, it's very easy to kind of willy-nilly do things with different levels of research. So I have this rule for myself. I go, I'm not going to own anything unless I've written a blog post about it. And it keeps me very honest with
That's awesome. I love that idea. Yeah.
With buying and selling. So it's great. It also leads to a lot of inbound from folks who own it, either retail or institutional. I've been shocked how many professional investors have reached out to me. That's a great aspect of owning a Substack. But that's what I've been doing in the blog. Has kind of been more successful than I could have ever hoped for. It's been great to really get to know a lot of people, go to conferences and cover things. And small microcaps are one thing I'm passionate about. But for me, it's always like, how do I get my IRR goals? And a topic on my blog recently has been, because rates are where they are, if you're looking for a 7 or 8% return, you arguably could take much less risk in fixed income than you could in equities land. So it actually makes the bar for choosing stocks a lot higher. So that's an interesting thing that's been going on. But yes, currently a software engineer. I'm on Klaviyo's billing team. Do lots of things around operations and making sure, we can collect payments and do all the things we need to do with our various integrations. And then, I'm not doing that. My kind of night and weekend job is just writing about stocks, which I'm here to talk to you about.
Very good. No, I appreciate the full background there. So, I mean, you say you started the blog in 2020 to kind of keep yourself honest. Like, look, if I'm going to own this, I want to blog about it. But even prior to that, what got you into investing? I mean, obviously you did the investment banking side, but, was it that originally inspired you to want to start building out your own portfolio, managing your own PA, or even before that, you're like, all right, I'm managing my own PA. Like, what can I do to make a career out of this?
A good question. I have an origin story that probably more people who are Jewish would care to admit about investing. Bar mitzvah money was significant. I was 13, and my dad, to his credit, was like, 90% of this you're not going to touch. We're just going to invest this, and your uncle, and me can do an investing club. And
see, you went the equity routes. I had the bonds.
There you go.
Everybody got me bonds for my bar mitzvah, but you got okay. There you go. I like that.
Yeah, the shame rates were so low all throughout us. My uncle really had a profound influence on me, because he was more into it than my dad was. He really wanted to do the stock picking thing and look at earnings and try to think about, should we continue to own this or not. I feel like it became more exciting in 08, 09 when I think I watched a lot of our paper wealth just dissipate before my eyes, but also it was crazy seeing my uncle become so active. And I feel like hearing him talk about why it was a good time to start looking at some equities. Ended up learning about Peter Lynch and Warren Buffett and kind of all the studs of investing other listeners of yours that have talked about. But that was fascinating. Just some of the things happening back then. Like I think Starbucks, it went through a whole saga with Howard Schultz coming back, and it wasn't clear if they were going to survive. Obviously, all the autos, like a lot of them, went BK. But I think Ford ended up being a survivor, and my uncle was willing to take a swing on that. Under Armour got very cheap a couple of years later. There were a couple of those where I was like, if you have some winners and you let them run, not only can it be life changing, but the tax treatment's really nice because you're not taxed until you sell. Overall, like I think doing that all from like age 13 to getting older, and also seeing how hard it was to beat the index too, because I think I have no illusions about my own ability to beat the index. Like the S&P has been an absolute monster, and even recently, I think lots of folks have been like, oh, you don't want to own Mag 7. Mag 7's overvalued. It's like Mag 7 has crushed this year, and it's been hard for anyone who's faded them. So also doing that exercise, I think I've been become very humble around like no matter how good your thesis is, no matter how much you think there's more to learn, and also you're competing against the 500 best companies in the world. So that makes it very difficult.
Very cool. That's a great starting point. I definitely very much relate to everything that you just said there. I mean, like I said, we didn't take the bar mitzvah money and do all that, but we, it was all family inspired, right? To get started and kind of look and see which books, all that kind of stuff. So, all right. So pretty much caught us up here today, having gone through your background and everything like that, how would you define your investing philosophy then today? What's an ideal investment? What's some of your key criteria?
I would say it starts with what return you're looking for. Especially my wife and I had our first daughter last year. I think that's maybe a much more conservative investor.
Awesome. Congrats. Buffett, that's awesome.
Thank you. Yeah, it's life-changing, amazing. But Buffett, I think maybe the last shareholder meeting, or it might have been two ago, had a good quote around treat every dollar of your own like your child's, right? Because eventually it will be theirs. So, I mean, I think that creates kind of a profound level of responsibility and wanting to be a good steward of your own capital. That all aside, this is a MicroCap podcast, but I think for me, I'm very comfortable just saying I'm going to take if I get 8% returns. I mean, I think historically equities, if you go all the way back to the early 1900s, let's call it around 10%. So call it like 8 to 10% would make me happy. I'd like to take the least amount of risk possible to achieve that. And so, I mean, this I think makes it hard to have a consistent philosophy, because getting that 8 to 10% could be easier or harder depending on where rates are, what's going on in the economy, what's going on with the macro, where valuations are, et cetera. I mean, I think it might have been 21. I think a lot of blogs were writing about getting the Series I bonds. Unfortunately, you're capped at how much you can get for those, but they follow CPI. So you basically have this ability to lock in a 9% return with government paper, in 21. And I think even now, when you look at municipal bonds, and where AAAs are trading, like I'm in Massachusetts. There are folks who know the city of Newton. I went out and bought general obligation city of Newton bonds for 5.5%, AAA rated. Depending on what your tax rate is, like a tax equivalent yield that gets you to that 8 to 10%. So my philosophy is really like, what's the least risky thing that gets you your IRR? That's where you start, and then any opportunity you look at, it has to be able to. It's all risk reward, right? So it's like, it has to be able to get you an equivalent level of risk reward. So I think for microcaps, there's no question it's more risk. Like I think James Elbar was just on Brendan Balo's podcast. I think did a really good job about talking through Parks America and some of what went wrong there and the ups and downs, getting to know the people and lots of things you would never know if you just looked at the stock from afar. But I mean, every company has it's different players, crazy characters, folks on the board. Like, you read enough business books, I feel like you start to appreciate there's a bunch of stuff going on behind the scenes that you don't know. With small caps, some of that stuff I think can be more egregious, perhaps because it's smaller and the level of corporate governance isn't always as good. But I think as I get to smaller equities or stuff that's not as well covered, or getting out of kind of that FANG Mag 7 area, I'm like, to get my 8 to 10% IRR, I probably need like a 30 or 40% IRR, really good case scenario, and then my base case maybe is like 10% or something. And then on I think there's lots of issues with probability adjusted basis just because you can't really tell. There's no way the probabilities, right? But basically, for small caps, nothing is breaking here. I really think you need to be able to underwrite a very significant, like best ever IRR at a low amount of risk, which is super hard to do, which again is why microcap, small cap investing is so hard.
To say the least. There's so much to dig into there. But one thing I wanted to chat with you, we were talking offline about your background, obviously, and your day job at working at Klaviyo as a software engineer. And this is something that we've talked about a little bit on the pod, but we haven't really dug deep with, I would say, someone that's in the field, so to speak, on the software side. And I've interviewed hundreds, if not thousands, of software companies over the years, and if there's been probably the main theme that's been of note, just within investing theme within probably the last 2 years has been AI and how it can disrupt and whatnot. There was always whenever somebody was putting together their downside thesis, what could go wrong with the software company, before AI, there was like, all right, well, how is this unique and different? What about this software is there IP involved, stuff like that. And now it's almost seems like there's an even greater headwind, which is AI, where anybody who's like, hey, I got an idea for the software, like, let me just hit up this tool, this AI tool to help me, build this out for me. So, from your perspective, when you're looking and meeting with different software companies or assessing them and putting your thesis together around it, how do you think about it nowadays? How much do you underwrite AI and the risk there from somebody just coming in, not necessarily using AI as a tool for that company to then, have more customers, whatnot, or build out their tool stronger, but somebody coming in and saying, I'm just going to use AI and just build that out myself. So I know I threw a lot at you there, but I'm sure you've been thinking about it a lot.
Yeah, it's a great question. And I think I just finished Brad Jacobs' book on some of his experiences at XBO and other stuff he did, and I was listening to this book a couple months ago, and he says AI has to impact every single investment decision you make, how you do the underwriting, how you think about it. And at the time, it was somewhat dismissive. It was like, it's probably overstating it. It's like this guy does building materials. Like, how could AI be related? And I think the last several months in particular have been extremely transformative for me in terms of starting to agree with him and starting to think, I didn't appreciate how right he was when I read that. I mean, I think one way to view this is when I started working in software, I remember there weren't enough software engineers. There were boot camps like all over the country. We were saying, we need to have more computer science graduates and stuff like that. And I remember I was shocked how many interviews I was able to get, with no relevant experience. So there definitely was a bull market for software engineers. Flash forward today, certainly not the case. But why was that? Why did that happen? I do think we went through a period in the 2010s and maybe even went all the way into COVID where there was a lot of legacy software out there. And some of that functionally was because traditional web development, let's back up, because I think a lot of people are like, what do you actually do for a living as a software engineer? So I'm a web developer, and the easiest way to describe that is I make websites and I help websites do things behind the scenes. So when you click a button, a certain thing happens. That's reductive, but I think that's a lot of what we do. And probably in the early or mid 2000s, I think you started to see more of these open source web frameworks. Like you might have heard Ruby on the Rails, Django. There's a couple others, but they just make it super easy to spin up a website and do whatever custom things you want to. I think Twitter was built on Ruby on the Rails. Klaviyo was built on Django. A lot of these companies started popping up where it was it only took a couple people to make them. Not a lot of people were familiar with working with these frameworks for a good amount of time. So I think the hiring market leaned one way. But yeah, I think it's fair to say, based on these open source web frameworks popping up and how it became much easier to move faster, lots of tools popped up. I mean, everybody knows about the cloud, but even build frameworks and make it easy to say when I push code to my server, I'm going to make sure Amazon S3 gets updated and these various EC2 services in Amazon also work, and this happens and that happens. That stuff has just got so much more powerful the last 5 to 10 years. The automation things people write about are completely real. And they've also got cheaper, right? Like originally it was just AWS, and now then GCP was there, Azure was there, DigitalOcean was there. So basically, we lived through this golden era of making it easier and easier to create websites that not just are great, aesthetically great and easy to use, but also scale a lot. Like I don't think Klaviyo or some of the other folks who kind of were in this latest generation of tech companies would have been able to exist without Amazon or some of the hyperscalers, because everybody knows this with the cloud, but again, worth restating. I think this might have been something I heard about eBay like way back in the day with Benchmark Capital. They really had to go to a data center and provision another server. Now it's like you can go to your auto scaling group in Amazon and do 10 click of a button. Now it used to be an engineer who did it. Now AI could do it. But that kind of brings us to today, where I actually think AI would not really have worked that well for software 10 or 20 years ago, because a lot of those automation tools I previously mentioned and open source web frameworks weren't there. Now they're here. There's documentation everywhere. People have written reams and reams of blogs, articles, official docs on how to do stuff. GitHub became a thing. Like I remember when Microsoft bought GitHub and people were like, they completely overpaid for that asset. But I'll tell you what, I'm on GitHub 24/7. There's open source repos everywhere. AI is 100% trained on it. I mean, there's amazing training data just on how to write code and then how to fine tune it. So I think software kind of was tailor made the last decade or 2 decades for this AI revolution, because AI works when you have really good training data and when prompting can lead to better results, because better specificity kind of tells the AI, I should look at this thing and do X, Y, Z. One more tool worth mentioning too is for people who do software for a living. I think most folks, when they think of AI, are going to think of like ChatGPT or Gemini or like Claude or one of those. For coders, it's really Cursor, I would say, is the big one. So Cursor is a company that came out of MIT. I think has been around for a few years now, but it's literally this editor. So like you see like coders on TV and they have the crazy editor like open to 4 different panes of code and they're typing. So it's an editor, and you're able to prompt it, or there's different kind of shortcuts. Command L to open up a window, I think Command K to open it in the code, and you can prompt it and it knows exactly what to do based on the quality of the prompt. It does mess up, it does time out. Like I'm not saying it's nirvana or perfect or anything, but a lot of the stuff where previously it might have taken a trained engineer to say, hey, I'm going to use like jargon, but I have a Django project. I need to change the object relational model to create this table and these columns, new migration, and then I need to put it on. I need to deploy it with these commands or whatever. You now could write that in a prompt, and again, there's so much prior art for how all this stuff worked. It can be done essentially immediately. So it's made my job a lot different. I would say my day to day used to be we use Python at Klaviyo, so that PyCharm is the name of the editor. It used to be going in, opening up a couple different windows, thinking about the change I wanted to, and doing it all myself, which is it's very focus intensive, right? You kind of need your coffee, or I'm a big Celsius drinker. It's now kind of like if you know the gist of what you want to do and how you want to do it, you can get a really good first pass, and if you're good at reprompting, you can get a really good second pass. And I would say, just functionally, that's saving hours and hours of time. And then that's before you even get to the fact that like we're kind of in this first inning of I say do X, Y, Z, and AI or Cursor or whatever does it. I don't think even people are even really employing some of the new stuff out there where you don't have to prompt it and it just kind of operates in the background, observes, and knows what to do. So I think I totally agree with folks who are like, we're in the first innings of this. I expect my job to change a lot more. I have no idea what the future holds, but I can just say the last 6 months or so of being a software engineer, it's as transformative as it's different as any point of the last 10 years I can remember.
Absolutely. Okay. I want to start. That was a great place to end it, because just to give context, you gave some great background here of where we're really at in terms of AI tools, especially using your own job as a proxy here. And again, I'm not pretending to be a technologist. I don't think anybody's really a technologist. It's like the goofiest title whenever I see
I'm
that.
definitely not. Yeah.
Yeah,
I'm
but
just a guy
anyway,
who writes code and gets paid for it
yeah.
sometimes.
See, that's perfect. To show how much of a schmuck I am, right? I'm not a technologist, but as a not as a noob non-software engineer, I think that was some really great background. And this is gonna be another noobish type question, but again, it's coming back to speaking to a broader audience that may not be specifically software engineers, but might be assessing different software companies and whatnot. But there's sometimes when I look at some of these microcap software companies and I'm thinking to myself, okay, based on everything that you just said, is the barrier to entry to even mimic that exact same tool that some of these companies are doing available for any Joe Schmo out there? And then what does that do then to my risk assessment now? How do you think about that when you met a couple software companies in Vegas? Not, you don't have to name any by,
Yep.
by name or anything like that, but like when you were listening to them talk about their products and how they're doing things, do you start thinking in your mind like, all right, can someone with the brain or that
Yeah.
knows how to
It's a
use
great
AI do
question.
this?
I think the laws of competitive moats have changed a lot for software specifically, but software includes hardware and it includes people and it includes processes. And a lot of those things, no matter what AI agent you have running, are not trivial to replicate. Especially, I think, on the infrastructure front, like at the end of the day, you need servers to store data, or you need hard drives to store data, and you need servers to run compute. And that those require often data center leases, or they require building your own data center. And that requires also like these things aren't being a hardware technician is not something at least immediately AI can replace. Like these are actually very people and time intensive projects in terms of going into a data center, finding the space, plugging everything in, making sure it works, getting all the wiring correct, getting the power needs correct. So I think AI is free, is going to be free, close to free. Compute and storage is not free. That still ultimately has to either come from a hyperscaler like Amazon
Well,
went ahead.
well, here, let me not to interrupt you, but let's say, for instance, you know, you can get to a prototype.
Yep.
Anybody can get to a prototype potentially, right? I mean, it's one thing to build out everything and like get into it, but let's say I wanted to create a marketing tech idea, or I have an idea where I want to utilize tech to better, I don't know, serve ads or something like that for any business, small and middle market, whatever. you know I can still just go and use AI right now. Say, hey, this is how I want to do this. Build out the software, build out a prototype of it, and then once maybe you get a couple customers, then once you try and scale it, then obviously then you have to start thinking about, okay, data center leases, hardware, bringing more
Right.
people in for technicians. So that's it. You're talking more about like the next step once maybe it's been proven out or you have a couple customers, right?
Yeah, I think that's one competitive mode. That's a fair point. Maybe I'll take it in another direction
Okay.
that could potentially shine light on kind of some investing frameworks or ways to think about this. Like, let's take Salesforce, right? I think a lot of people who have worked with Salesforce are like, "Oh my God, it's Salesforce! This UI is so hard, and I can't figure out why this table is the way it is, or how to integrate it with this particular software or whatever."
That was me like 10 years ago.
Yeah, I've been there. It's still software that's incredibly robust, can do a bunch of different things. The APIs have taken years, decades to develop. They've bought, I don't know, 10 plus different companies. Even recently with like, I think MuleSoft was a big one, and Slack. And there's a ton of others I'm forgetting, but it's basically this conglomerate of software companies, all who do very different things. Salesforce may not have done a great job of stitching them together, but the entity itself like has incredible earnings power and cash flow, and they're doing things with AI agents that are showing up in results, or appear to be, at least as of now. In terms of like, why couldn't some Joe Schmo just come in and tell Cursor to build Salesforce? I think you'd have a really hard time stitching together all the layers of software that it's done over time. Like, and I know I'm kind of contradicting myself because I'm saying they've done all these acquisitions and haven't stitched them together, but Salesforce and the company Salesforce bought can talk to lots of other different types of software that ecosystem is so powerful. You have companies that are just building specifically for the Salesforce APIs. So I think that's a huge competitive moat. Another thing I'd say about Salesforce also is there's kind of this friction thing, and some might call it vendor lock-in, but it's very hard if your stack is on Salesforce or my brother works in consulting and has done a lot of stuff with ServiceNow. They have a similar thing going on. Although they've been very AI forward. You build your entire workflow, marketing stack, CRM, whatever, on these companies, and that level of commitment is hard to migrate overnight. Even if it was easy to migrate to overnight, you got to retrain people. You got to find someone who can offer it cheaper and at the same level of support. So that's kind of what I mean. In addition to the hardware barrier, I think there's a people and process barrier that AI is maybe somewhat of a consideration, but I think it's going to be very difficult to take away those moats.
Absolutely. So, okay, bring it to microcaps then specifically. Like when you're, when you're in that meeting with, that software company and you're putting together, the main questions, or when you're putting together your thesis on that company, what are some of the main things you're thinking about? And it could be AI related or not, but what are some of the main things you're thinking about when you're like, all right, this might be worth looking a little bit more into?
Absolutely. Yeah. I think for many software companies where this has kind of become a thing in software, like we're going to be a rule of 40 company and grow at 30% and have 10% free cash flow margins. So like software, multiples are high and they're high for a reason, right? Generally, like growth can continue for a long time and margins can flex. So I think the questions you got to come in with have to kind of reality check the margins piece and the growth piece. On the growth piece, this is perhaps personal experience, but I usually think a lot of people think they're going to grow by going into enterprise. So it's like, oh, we started with the small fish, and we're eventually going to get the whales, and that will kind of drive this 30% CAGR over time. Enterprise sales is really hard. Like, there's RFPs, there's security requirements, there's massive, incredible levels of sign off depending on the security needs of what your product is. So you really have to be great to kind of get into enterprise sales. So I think that's one thing I look for immediately if they're selling to larger companies. What give me some of your recent wins and why did you win there? Like as a good example, Backblaze is something I've written about on my blog a lot. Backblaze, I think, does a decent job as a data storage provider of talking about recent customer wins. Like we're both sports fans, it sounds like. I think they have the Eagles and they have the Rams who are using them for video. And they posted the case studies. They talked about them. They talked about how they do data recovery, how they're able to they have this new product called Overdrive, which can move large amounts of data very fast, which some of their AR customers have requested. And they've talked about that being a factor in deal cycles. So when I get really good collateral from management teams on here's why we can win in enterprise and here's how we have won, right? You obviously need some of the track record. I get it can be kind of chicken and egg. I think some of those growth rates become more believable. Second thing I would say on margins is you have to have some view on like where could margins go long term and why can margins get higher or are margins at risk. That's where I think AI becomes a big factor. I won't name the company, but I heard a story that a company that was basically selling an AI product as a requirement to buy their other product, and then counting those AI sales, which I guess that speaks to the strength of their other product, but that doesn't speak to the strength of their new AI stuff. So it's almost like you view that as a price increase as opposed to this new AI business unit. But with margins in software, it's tough, right? Because most of the time things are getting cheaper, and especially when like the marginal cost of creating software is so cheap, you really do need some competitive advantage. I mean, with Backblaze, I think what's given me a little bit of sanity there is the amount of data in the world is just growing a lot faster than anyone can keep up with, and even if Amazon or the other hyperscalers could keep up with it, there's value to kind of distributing your data across different providers for security purposes and hedging and diversifying. Backblaze is able to do it much cheaper than Amazon can because it doesn't have to provide all the bells and whistles of being an Amazon server and doing XYZ and being in this data center and working with these other products. So there's interesting things where it's like positioning results in margins that can potentially be somewhat resilient. But that's to your question of like, how do I think about software? I think it's growth and margins. And then if we're talking about AI, it's like, is AI going to have a big impact on either?
Very cool. Real quick, I have to do some housekeeping, compliance housekeeping. We mentioned a number of names.
Yes, go ahead.
Consumer Portfolio Services, Starbucks, Ford, Under Armour, Parks America, eBay, Klaviyo, Amazon, Microsoft, Salesforce, ServiceNow, Backblaze, shareholder in any of them.
I think all of them.
I do all.
Yeah.
There you go. All right. Well, you bring up an interesting point. I mean, the other thing I think about when I think about software as well is that, or at least software companies, software as a service, ad tech, marketing tech, all that is I think probably the main question I like asking all of them too is what is their competitive advantage? Like, how are they going to scale and grow faster than some of their competition out there, or how are they competing with the elephants in the room? That's always been something I think quite a bit about when I'm talking with them, and because it's tough, you're the small 50 million market cap ad tech going up against billion-dollar names to win that business, and it's like, where do you compete? Price?
Right.
Okay,
It's gonna be hard.
yeah, like, all right, price, okay. I don't know. I'm not saying that there isn't value or there isn't software companies out there that aren't but I feel like the niche plays have been interesting. The ones that have been attacking like individual industries and whatnot.
I mean, a good example of that recently, and what's funny is like I actually think AI is almost a reverse trend here. They were at Plant MicroCap. You set it up, so thanks to you. IntelliCheck, I think, is a really good example of kind of this niche industry of ID validation, and they do some stuff with biometrics, but you can really think of it as ID and barcodes. But when you think about competitive advantage there, it was so interesting talking to that management team about how do you actually verify an ID, right? There are effectively two approaches. One is you scan the barcode and confirm, does the barcode say this person has the ID they say they have, versus another approach called templating, where you can take a picture of it and do front and back and say, like, can I actually validate the picture? The problem with templating, right, is like we're getting so good at faking images. You're kind of getting up against the wall no matter how good AI gets, right? Because like if you can replicate any image, the templating approach, you're also kind of having AI working with the people who want to do counterfeits and frauds and things like that. And credit to that team, they did a great job of bringing in 6 different IDs that clearly were fakes, but they all look real. And it's like they're marginal gains to AI in terms of saying what's real and what's fake. They're just based on the image versus the barcode. Barcodes, the way they're constructed, you can get 1-to-1 in terms of like, this is guaranteed to be a unique barcode. I can run the scan. It's proprietary against a proprietary database. So that was an interesting one, just in terms of like AI actually is not helping, at least if you're using image templating as your way of detecting fake IDs.
That is very interesting. But shareholder in IDN? No?
Shareholder in IDN, yes.
Oh, there you go.
That's been a nice one recently. Yeah.
What? Yeah. So you also, I mean, this is very related too, but you mentioned this already a little bit earlier, and you talk about a lot on the blog. I don't want to just say recently, but I feel like for a while now also, is data centers. That trend has obviously been covered quite a bit. I think geo investing has been talking about a lot as well. So, I mean, what's your thesis on data centers beyond the obvious, right? Maybe a nuanced thesis, not to put you on the spot in that sense, but, how are you thinking about data centers? Where do you see it going? What are you looking for? What's most interesting, key criteria that,
I will say with data centers, I think there's a lot of experts out there, like the semi-analysis blog, which I'm sure lots of folks read, is incredible. And in no way do I have that level of knowledge, but it's still a space I like to follow, and I feel like there can be good ideas that come out of there. So I do think what's obvious to me is just following. So I don't own NVIDIA stock, shame on me. But having followed, I feel like every investor has to follow it every quarter because there's so many interesting insights that come out of those calls. And I think one I didn't necessarily think about is this big replacement cycle with semiconductors. So it really does feel like NVIDIA with some of the chips has the whole iPhone cycle piece going on, where it's like every new iteration is so much more powerful and the specs are so much better. You basically have to upgrade your entire data center to have those GPUs. And I think that's probably not too far off from other trends in data centers. For instance, liquid cooling and how to cool down some of these servers that get very hot. It feels like that technology is going through lots of iterations right now. I think it was on Bloomberg. There was a good video that was about OpenAI's effort to build this massive data center, and I think this small city in Texas. But they're really starting from the ground up, and just watching their engineer walk through. Here's what we have to do with cooling. Here's how things work with temperature, and we're in Texas, so things get really hot. The power requirements are a lot larger. Like, what is it? I think a gigawatt, people say, is 750,000 homes, or could do an entire city. And now we're building data centers in significant excess of that. So these are like power capacity requirements nobody has had to think about before. And I think the level of demand just keeps surpassing what people think is possible. Now, I think it's hard because you're getting into hardware, and right, there's a reason like you don't see that many hardware startups. It's a very difficult space to break into. Technology changes fast, suppliers change fast. So like, there are geopolitical things that can happen, and no view on tariffs. I have no idea what's going to happen, but I do know for a lot of hardware manufacturers, it is going to have an impact. So I think in terms of my view of the data center, if you have specialized knowledge and you have a good thesis at a good valuation, I think there's a lot of opportunities there. But I think just like going off on a kind of second order effect level, it's obvious to me we're going to be building more data centers, and we're going to be building them with better hardware. And there's going to be this big innovation cycle of each unit of power is a lot cheaper. And so you are able to have lots more compute at cheaper prices, which opens the way for lots of different applications and ideas. So going back to like our software company discussion, I think there are software companies that benefit that, and it is a nice tailwind for margins, because basically you're saying like, maybe they have a business right now that isn't free cash flow positive and is super compute heavy. And I think a good example of this, I'm not saying like these companies aren't public and I wouldn't necessarily want to be long, but it's like I hear people talk about Perplexity or OpenAI, or a lot of the other kind of model providers, and it's like these guys are losing money. This doesn't work, but it's like it doesn't work right now. It's very difficult to say like how much cheaper and by what order of magnitude things could be a few years out. So I think the only thing I know for sure in data centers is that things are getting cheaper and things are getting better in terms of hardware specs.
Very good. No, it's sometimes when I think about the data center thesis, I think about, I think about cannabis a little bit. And there's the cannabis real estate play where, we just have these massive growth facilities, and, especially in microcaps, thinking in the evolution sometimes of some of these, trendy themes, it went from, the cannabis to crypto, back to cannabis a little bit. And then, this is a perfect out for anybody that thought they were going to do like a cannabis real estate play. It's like, we have all this space. We throw a couple,
yeah, unfortunately,
there's some towers in here,
I was an investor in the MSOS ETF, which is like the interesting, that thing is not performed well. But I feel like one learning experience from that was, you think you can be ahead of what's going to happen with regulation, but and you think all these things are going to happen with this ecosystem with cannabis, but ultimately, like, it is supply and demand, and it's like you have a bunch of supply coming online, and demand doesn't keep up. Like, bad things tend to happen. I think with all like kind of new trends and like thematic investing, and as a side note, like the Citrini newsletter, which I think other folks probably read, has been so good with that. What makes it hard, I think, is like understanding the trend and understanding it well is kind of maybe different from getting it right. And everybody knows that Buffett quote about like, all these industries, if you could have bet on like 99% of the companies involved, it was going to be 1% that really got you over the hump. I wouldn't doubt in data center, like in kind of adjacent industries, that particular way of thinking about things is still true.
100%. So going on that type of question and thinking, it's my favorite question I like to ask everybody on here. But what would you say is an investing experience that really changed your mindset, your thinking, thesis, what have you? Let's go. Let's hear it.
My friends who watched me go through this are definitely going to be laughing hearing the story. So my blog, if you go back to 21 and 22 and 23 even maybe, heavily covered national cinemedia. The quick backstory of this company is they basically came out of the major theater chains and have all of them as kind of captive customers. You're at a Cinemark and you're getting ready for a movie to start and you see an ad. That's probably an ad that National Cinemedia served and got paid for. It seems like this great kind of oligopoly, almost monopoly business. And it seemed like a great time to buy it because in COVID, everybody thought movies and theaters were dead. What's amazing is they weren't. The box office actually did really well in 2021 and 2022, and even set some individual records. I think the second Top Gun movie set like every record in the book for releases, and overall, like the box office came back. If you had invested in Cinemark or like IMAX, you'll see both of those companies actually were able to increase earnings and do buybacks, and basically treated shareholders quite well during that time. National Cinemedia, I mean, I think the main lesson I learned from this is leverage cuts. Like at one point, this company was levered 10-1. It kept amending and extending on a leverage covenant. What really put it out of business is I think Regal went bankrupt too as a huge customer. It just wasn't clear how they were going to restructure the contract. You never want something like that to happen when you're already kind of on thin ice and a lot of your debt holders are not happy. So it's like you always think you have forever investing. I think it's a common thing with microcaps where it's like, I might not be right this year, but give me a 5 to 10 year time span. I'm going to be okay. If you have a company that is heavily levered and is a small equity stub, you don't get the benefit of time because something bad happens, and then the bondholders are going to circle in, and the equity is getting nothing.
That is a great example. All right. Well, we're running up right up against it, but final question for you, I'm sure we'll have you back. We'll talk, even more software, all this stuff this all continues to evolve. So I'm sure I'm going to have even more, really brilliant, dumb questions. But to close us out here today, what advice would you have for anybody listening in that is either new to microcaps, new to investing, or wanting to look at software, AI, data center, that kind of stuff? What advice would you have for any newbies? First place to start, how to think about it? Where would you go?
I think my advice would be turn over every rock. Like that is like a trite Buffett quote that's getting passed around a lot, but I couldn't agree with it more. And I feel like to give tangible examples, I've recently been loving talking to management teams, talking to IR, and talking to other shareholders, some who used to be long the stock and aren't anymore, and others who are still long the stock. When you talk to all those people, you get a ton of different opinions. And I think also the incentives matter here too, because you read a proxy and it's like, management owns X% of the stock and they get paid on this. Sometimes what they tell you will be a reflection of some of the incentives they have. So it's like you also have to weight the information appropriately. But I think earlier in my investing career, like when I was a bar mitzvah boy of 13, it never occurred to me like, hey, there are real people behind these companies with real incentives, and especially with small caps, like those incentives can be quite impactful, right? Like without getting into details, I used to be a shareholder, still am a bit in 180-degree capital return. And they're going through this merger with a company called Mount Logan, and you have shareholders taking sides, and management wants the merger to happen, but there's lots of ways to read into their incentives of why they want it to happen. And it's like if you had just read the deal proxy or just read the calls, it would have been very easy to be like, yeah, this deal is obvious. But continuing to turn over every rock, talk to people, talk to investors who have been through these experiences before and can give you examples. I think it's just been enormously helpful. So I think it just goes way beyond 10K, 10Q reading filings. Like the actual talking to people and like continuing to kind of ask good questions is something I'm really appreciating and want to do more of. But I think among investing lessons I've learned, just like have that curiosity and realize it, and talking and asking and thinking and doing more than just like the bare minimum amount of work is huge.
That's a perfect place to end it, and great advice. Absolutely. So Ben, with that, where can our audience go and find more information about the Stock Talk newsletter, as well as follow you on, you're on social media, I think.
Yes. stocktalknewsletter.substack.com. I'm on X a lot. BMB21. I don't know why I chose that username, but yeah, BMB21. If you just search Ben Brostoff, you'll find me. I like to talk about investing on X, but those are the two big places.
Very cool. All right. Well, Ben, thank you so much for joining me today. Really do appreciate it. Good luck. Stay safe. And I look forward to our next update.
Awesome, Robert. Appreciate it.
Thanks, man.